This is a free sample of the book, The Financial Red Pill by Cairo Copeland. The first half of this book is posted right here on YouTube, free for everyone to listen to. If you like this content and want to hear or read the rest, or want to listen to it free of ads, visit reinventideal.com/finance. The book is available on Kindle, paperback, and Audible at reinventideal.com/finance.
Chapter 3, the most important money lesson you'll ever learn. This is the most basic principle of financial planning. The ones who got rich and never have to worry about money again, they didn't win the lottery or invent some amazing gizmo. Now some did, but not most. The rich among us are actually not smarter than you. They are not more fortunate than you either, because wealth is not a matter of fortune, but rather formula, and they know this formula. If we look at the rich, we'll find something in common that they all do. Better yet, what if we look at something greater than the rich person? Let's look at the multi-billion-dollar publicly traded company, corporations, international corporations. There's one thing they all do as well. They use two particular tools and one specific formula to rank in the billions each year. The tools are the cash flow statement and the balance sheet. Now the formula is as follows: income greater than expenses plus assets greater than liabilities, and that equals wealth. And the formula can be applied and kept track of with the help of a cash flow statement. And what you can do for that is just get an ordinary piece of paper, draw a line right down the center of it. On one side, put all your income sources. On the other side, put all of your expenses. And the income, of course, is probably your job or anything that puts money in your pocket. And expenses are any of the things that take money out of your pocket, like bills. So how that looks is, on the income side, you put down your salary. For $2,000 a month. Let's say we're at the poverty level here. Expenses, well, we got rent. That's $800 a month. Utilities, I could say that's $200. Insurance is $150 a month. Food is $250. Gas is $100 a month. Credit cards, $150 a month, and so on. This person's living on the edge here in this example. Now, the first step in achieving this formula is to reduce expenses below your level of income so that there is an income surplus. Now, it seems simple, but there's far more to this formula than simple budgeting. I mean, after all, you'll never build substantial wealth by saving money. That's not how it's done. You build it by spending money, but spending it on the right things. And that is what most people don't do. The key difference between the rich and the poor is that the rich buy assets and the poor by liabilities. Now, what exactly is the difference between the two? Well, assets put money in your pocket, whether you work or do not work. And liabilities take money out, whether you work or not. The single greatest way to determine whether something is an asset or a liability is to do this. Stop working, and your assets will keep you afloat, but your liabilities will try to drown you. And that's where the balance sheet comes in, which is just another piece of paper like the cash flow statement. You draw a line right down the center. On one side, you have your assets. On the other side, you list your liabilities. Now let's think about this here. What are some assets? Stocks are something that can put money in your pocket, so that counts as an asset. A business you created on your own with your own money. If it generates a profit, it's an asset, so that counts too. Any money set aside earning interest, or anything you own that grows in value over time, could be considered an asset. So it could be a mutual fund, investment real estate, or cryptocurrency. But with that in mind, what are some liabilities? Well, these are the things that cost you money just to own them. Some people actually consider a fishing boat an asset and list that on their balance sheet as such. But doesn't it have a cost of ownership? You bet it does. The same goes for houses, cars, and other big boy toys. You see, here's the problem that so many people are running into, and this is why most people are not rich. They look at those things, and they think, oh, that's an asset. I'm going to put that on the asset side of the balance sheet. they're thinking about it all the wrong way because these things have a cost of ownership and they're pissing money away left and right on it. So for most people, what they do with their income statement and their balance sheet is this. They have their salary coming in and it's covering their expenses, but then it's also covering their liabilities, like a boat or a really cool car. But they don't track that because they think of those liabilities as assets. And that's where they get tripped up. So after their living expenses are paid, they use the rest to buy liabilities. And these liabilities can be anything from new furniture to a cooler phone, a computer, a car, or even a house. Now, they don't sound like liabilities to most people because they are useful, but the bottom line is that they take money out of your pocket. They depreciate in value over time and probably have more costs rack up in the future. So just to look at the car, for example. It requires maintenance, gasoline, insurance, and tags. These costs add up and take money out of your pocket. And as far as a house goes, most people believe that their house is an asset. Their realtor told them that it would be. I remember watching Susie Orman on her program where she said, "Your house is the greatest asset. It will always appreciate in value." And that was before 2008. And we all know the trouble that people ran into believing that. Let's not forget, houses come with mortgages. Houses require homeowners insurance, property taxes, home improvements, and maintenance. These things take money out of your pocket each month, and that makes the house a liability. And I'm not saying don't buy a house. I'm saying just understand it for what it is and know what you're getting into, the cost of ownership. But the wise man uses their income to buy and build assets and investments such as stocks, bonds, ETFs, mutual funds, self-running businesses, ebooks, info products, tax lien certificates, cryptocurrencies, etc. And then use the money the asset gives them to pay for expenses. And then the mega rich will do this. They'll bring in their salary, use it to cover expenses, but there's still some left over. They take the leftovers and they put that into their assets. And then their assets cover their expenses as well. And also cover some liabilities that they're owning just because they enjoy the liability, like a fishing boat or a cool car. But it's all covered. There's a present day movement going on that I couldn't be behind more enthusiastically. And that is the FIRE movement, which stands for Financial Independence, Retiring Early. The successful members of this movement are the ones that use their excess income to buy enough investments that not only exceeded their expenses, but allowed them to quit their jobs entirely, to be set for life. And this is what you want to achieve. That's that state of fuck you money, financial freedom. And the balance sheet is how you determine your net worth, which is your assets minus your liabilities. And this is basic accounting, and all large corporations do this. Many of the rich got their wealth from investing or owning large corporations and thus adopted the habit of using these two financial statements, the cash flow statement and the balance sheet. It's time for you to do the same. Some additional advice to throw your way here. Make an income and expense statement or a cash flow statement. It can be on paper or an Excel spreadsheet, but just make one. Just get started. Or you could use the smartphone apps like Mint or Personal Capital to track your expenses. That will show you where your money is going, and that is the essential first step. Once we figure out where the money is going, we can find a way to stop it from going to needless shit. Look for opportunities to cut. One client of mine was going through their cash flow statement and found wastes that could easily be cut, like 25 cents a day on a newspaper and $1 a day for a vending machine drink. It doesn't take a drastic lifestyle change to get enough savings going. It only takes time. Make your own balance sheet too. It can be on an ordinary piece of paper or an Excel spreadsheet. Write down all the things that are liabilities, the things that have costs of ownership, or things you carry that are taking money out of your pocket every year, like debts. Monthly bills would not be included on this because those would be included as expenses on the cash flow statement. Instead, for this, write down the whole lump sum you owe for a debt, like a mortgage, not the monthly or annual payment amount. If you have anything that is appreciating in value or providing a stream of income, write that down on the asset side of the page. While you may not know what assets you will eventually have in the asset column, do think about how much money you will need these assets to earn to first outweigh your liabilities, and second, to replace your income to cover your expenses on the income and expense statement. This will be your overall milestone for financial freedom. So I'm having you do this here because what you want to accomplish first is, 1, in the cash flow statement, make sure that there is a surplus left over, which you're doing at least once a month. Some people will do it once every paycheck. They'll make a cash flow statement. Either one is fine, but at the end of each pay period or each month, you want to make sure there is a surplus of some sort, even if it's just $1, and then do whatever you can to work harder and save more to increase that surplus. And once you've increased that surplus, you're going to put it over onto the balance sheet on the assets side of the balance sheet. And from there, your goal is to keep growing those assets as much as you possibly can, and then have them become assets that are earning so much where a 4% return on them exceeds your living expenses. When that happens, that's when you've reached financial freedom, and that's when you'll never have to work again. And it's the greatest feeling ever, one of the greatest accomplishments a guy can have.
Thank you for listening to this free sample of the book, The Financial Red Pill by Cairo Copeland. If you enjoyed it and want to hear or read the rest, or want to listen to it free of ads, visit reinventideal.com/finance. The book is available on Kindle, paperback, and Audible at reinventideal.com/finance.